everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, as always, keep in mind that there's risk involved with each trade that you take. So you want to manage risk in a way that makes sense for you. And we'll go over some ideas in that regard. The order window within the web trader and our app really makes the risk management side of things pretty simple in terms of calculating exposure and such. Also keep in mind that what we go over is not meant to be financial advisement, but is coming from an educational perspective. Now, from our main website, we can log into the web trader platform, which allows you to trade on both MT4 and MT5 accounts from the same location. And the same is true with our app, which also has the same extra functionalities and features that you'll see in our web trader. So as we log in the upper right-hand corner here, we'll find ourselves in the web trader platform. Now, as we get started, we should probably talk a little bit about the fundamentals leading up to today, and then kind of get into the new stuff that is coming in today. So over the past couple weeks, the news has kind of fizzled out a bit with regards to the tariff fears. There hasn't been a lot of new talk about the tariff situation with the US and the rest of the countries really around the world. So it's kind of tapered itself out as not really being the leading headlines. What kind of took over the last couple of weeks is questions about US monetary policy, rate cuts. Do they feel like they're going to lower interest rates quickly or not? And there has been a bit of a shift starting a couple of weeks ago with Jerome Powell out of the US with the FOMC committee, seeming to shift gears into maybe agreeing to rate cuts between now and the end of the year. And indeed, they cut 0.25% off the interest rate in the US in their last meeting, which was just last week. And so that's kind of kickstarted what many believe will be a series of at least 0.25% rate cuts. But we'll see. They certainly did not commit to that, which made the markets a bit nervous. And actually their dovishness in that regard in terms of not committing to more rate cuts this year and kind of leaning on the old phrase, it depends on the data. It's all data dependent with each meeting, etc., rather than laying out a clear path. It created some nervousness even with the rate cut that perhaps the rate cuts won't be very rapid or sizable moving forward. And so we saw the markets actually pull down the last couple days, really, the last couple trading days. And so we'll see how that carries out moving forward. We do have some renewed tensions between Ukraine and Russia and perhaps the rest of the NATO countries, where there's been some minor incursions, I guess you could call them minor, but maybe not if you lived in those countries. Some of you might be in some of those countries where Russian aircraft have gone into airspace that's considered NATO airspace. And, this could trigger what they call an Article 5, where all countries agree in NATO to defend any NATO country if they're under attack, that sort of thing. And not that they've been under attack, but certainly violating airspace creates some nervousness. And Trump was asked during the UN conference yesterday in New York if he believes NATO countries have the right to shoot down or if they should shoot down Russian aircraft if they enter their airspace, and he simply said, yes, I do. And so some of the countries actually responded back with phrases like roger that, got ya, that sort of thing, that they confirm that they understand they have the right to shoot down Russian aircraft. So that's creating some nervousness, that not that that's going to happen, but nervousness that potentially it could happen. And so I think there's some reason beyond the apprehensive rate cuts in the US, maybe for there to be some jitters on the market right now. And with those storylines, looking at something like, and I already pulled up the chart for us to look at, looking at something like crude oil could make sense, okay, for a few reasons. Number one, the US did lower interest rates. They're on a path maybe to lower interest rates further. There's some uncertainty about that, so maybe a rush out of the US dollar isn't going to be huge necessarily, because it's not like rate cuts are guaranteed at the next meetings. And rate cuts tend to weaken a currency and make it less valuable in general. And so, but that path did start with rate cuts, which tends to be inflationary. As you start to cut interest rates, it makes the prices of goods and commodities rise easier as interest rates get lower, because money's cheaper to get your hands on. It becomes more plentiful when people can get lower interest loans, etc. And so that creates more buying power, and that could drive up energy demand, etc. And at the same time, if there's tensions with nations that produce energy, like Russia, and threatened perhaps sanctions on those commodities coming out of different countries. This could be also Iran, this could be Russia, etc. And so it seems there's some fundamental reasons why there could be nervousness about crude oil supply potentially being disrupted in the coming weeks or months. And so combine that with maybe some fears about rate cuts causing inflation to go up in the US, and it could be a recipe for crude oil to have a reason to climb. So if you kind of put that set of facts together and you feel like there is maybe a reason for crude oil to go up at this point, not to mention that as you cut interest rates, the currency itself being weakened is enough to drive interest into other investments. Then you combine the situation with Iran and Russia in terms of sanctions potentially going on their crude oil, and it may create a situation where you're better than 50-50, thinking the fundamental news leans towards crude oil going up rather than down. And so if that's the case, if you feel like it's better than 50-50, even if you think 60-40, 65-35, etc., that you feel there's more fundamental reason for crude oil to go one direction than another, then you start to look at the technical setup. And so in this simulation, we'll presume that the feel is there's some reason, at least in the short term, in the coming days and weeks, to have some fear that maybe crude oil prices could spike up because of different regional conflicts, etc., and monetary policy along with it out of the US. Then that puts us in a situation where we look for technical entry points and exit points for a buy on something like crude oil. So as we look here, we see that there's a nice, and let's draw a line down here. There's a nice technical support down here. Okay, that's held for some time. These are one-day candles, so this is held for weeks, and the price hasn't dropped below this area here for quite some time, going back to June. All right, so we see support, one-day candles hitting this price and bouncing multiple times, and again, just a couple days ago. So this looks like a healthy support level that would take some serious fundamental news for crude oil to go down and break below this price in my eyes with how I'm reading these candles. And so since rate cuts have launched in the US, there doesn't seem to be reason for huge economic slowdown and a decrease in energy demand. And there doesn't seem to be reason to think there's going to be a huge increase in supply of crude oil, given that there might be sanctions and tariffs right around the corner on Iran and Russian energy supply. So what we look at then here is maybe we trust the support level down here more than we trust resistance levels up here. And that's where the fundamental news helps you decide which direction you think is more likely than not. And given the situation as it is now, it feels like the support level maybe can be trusted more than the resistance levels. And so then that makes it an easy decision from a fundamental perspective to start to look for resistance levels up higher that you believe the momentum could carry to. And certainly this price level here, wasn't that long ago that we were up at this resistance level here. And I see that as the next technical resistance on the chart, where several points of contact got close to this price and dropped. Once, twice here, and a third time here where it hit and dropped. Okay, so if we're looking at 67.88 as a potential take profit, so now we can start to do risk management and say take profit 67.88 would be right at this resistance. So maybe we say 67.85 just before that resistance. So 67.85. Okay, that looks nice, 23,000 plus USD potential profit. But obviously I need to look at the risk side of things. So when I'm looking at this support level here, I'm thinking if my stop loss gets down below that support level, that it would take a huge fundamental shift in momentum right now to break below this support. So I'm looking around 61.25, 61.40, 61.30. So I think 61.30 gets us below that support level. It's below all those wicks on the one-day candles. So 61.30 for a stop loss. And now I see I have about equal risk and reward. Okay, potential profit around 23,000, potential risk around 25,000. And now I need to adjust my trade size to be the amount of risk and potential profit that I'm comfortable with. Yeah, it's about a 1-to-1 risk reward setup to get below this support level and to have my take profit just before this resistance up here. Okay, so now I can start to adjust my trade size. If I go one lot, I'm risking 3,400. And maybe I'm comfortable risking 1% of my balance or 2% of my balance, whatever that is for you, percentage-wise or number-wise per trade that you're comfortable risking. And maybe I go a little higher than the typical 1% per trade, since this feels to be a longer-term type move. And so maybe I look for 1.5% risk, something like that. And that's up to each individual trader, how much you're comfortable risking per trade. Now with half a lot, I'm risking a bit more than that. So if I go to 0.2, now I'm risking just over 1%. And maybe I go 0.25, and I'm getting closer to 1.5% or so risk on the trade. And maybe I'm comfortable right about there, around 1.5. 1% is like 612, 613. And so this is about 1.5% risk to go after almost 1.5% profit, a little less than that. Okay, and you know, the ratio of potential profit to risk, that's determined by the technical setup and where I'm comfortable getting my stop loss, which is just below this support level down here, and my take profit just before the resistance up here. Now you could be a little more negotiable with the take profit. I could say, well, there's not that many points of contact at this resistance level, and maybe you feel that a stronger resistance is up here, where there was a much stronger reversal, where it hit this price and then really came crashing down at this point here. And so you can start to stretch your take profit up and say, okay, maybe I go towards this round number of 70, and I'll get out at 69.5. Okay, and then you start to say, okay, 69.5. Now all of a sudden my take profit is much better, and you can always manually close earlier if it gets up to that first resistance level and you decide maybe you want to close half the trade. Okay, but you could give yourself a chance for a little larger potential profit if you feel this is a longer term type move and shift with crude oil over the next, say, weeks or months. Okay, so we take a look at the setup, risk reward. We've got our risk management set up. We know how much we're risking. We know we have our stop loss down below this support level, down in this area here. And we know our take profit now is up here just before this resistance area here. Okay, and obviously, if it gets up near this first resistance that we drew, maybe you manually close half of it if you're in a nice profit to conserve some of the profit, or close a certain percent of the trade early and let the rest run. That obviously you can do as well. So if you're comfortable with the risk management, the setup, we're in the buy direction here, then you're ready to go. And you place your trade with the technicals thought through the risk management thought through with the technical analysis, where you want your stop loss, your take profit, and the directionality determined more by the fundamentals. Okay, I see a question that has come in. Okay, so the question is, if a big surprise comes in, like a large data set, like if US inflation numbers came in higher than expected all of a sudden, how would you decide what to do? And you know, what we're looking at here is anticipation of potentially something like that happening already with this example of a crude oil trade, meaning interest rates are starting to be lowered already. That tends to be an inflationary move, right? The reason the interest rates were held high was to bring inflation down, to make people spend less, to create less demand, to bring prices down. That's why the interest rates were raised. And now lowering them down is with the intention of making it so people have more money in their hands, so that they're not struggling so much. But at the same time, then that runs the risk of inflation going back up, which you've seen gold go racing up to an all-time high just the last couple days. Why? Obviously, there's fears of inflation again. There's fears, you know, of lowering interest rates, creating more demand on the economy, and that could run prices up. So sometimes, to answer your question, if the U.S. inflationary data comes in higher than expected, sometimes the movement has already occurred leading up to that. There might be anticipation that that might occur. But I understand, obviously, if it comes in much higher than expected, you could see a rapid movement, and it very well might be in the direction that would work for something like this crude oil trade. Because if inflation comes in hotter, as you describe it, than expected, that's a sign that prices are rising faster, that the US dollar is weakening faster than expected, and that could cause a rush out of the US dollar, which then could cause something like crude oil or gold, which is paired against the US dollar, to rise even easier, as there are fears of inflation. So that's a good question, and all of this kind of ties together to that idea. You know, in one case, you may be trying to anticipate inflationary moves, like with the crude oil move that we're simulating here. In another case, you're waiting for the data to come in to make your move, which then you have a lot of smoke around that. In the short term, you could get a spike up, a spike back down, as there's a lot of game playing with buying, selling as that data comes in the immediate hours after. But once the smoke clears, then you can start to think about the macro view, as you said, and you know, higher than expected inflationary data. The macro view would be, wow, they might not lower interest rates so quickly then. That might stop the decrease in interest rates, which could then cause the US dollar to strengthen and pull something like gold and crude oil back down, if that was the case. Because once the price is cooked in and the US dollar weakens as a result of maybe higher than expected inflationary data, if that was to happen moving forward, then the alternate response is, okay, well then interest rates might not be lowered any further, and then you get a rebound the other direction. Okay, so you have to anticipate what will happen after you already know what the data is. Very good question. Okay, so in this case, we're anticipating potential fears about inflation because interest rates have been lowered, and in particular, this combination with crude oil is maybe a little bit more fundamentally strong, because there's also fears when it comes to crude oil supply that while there might be sanctions slapped on Iran, there might be sanctions and extra tariffs slapped on Russian energy that goes out to the rest of the world, whether that's natural gas or otherwise. So this is a situation where there's a lot of pressure maybe on something like crude oil. If indeed inflation starts to creep back in, there's extra pressure on something like crude oil because of those regional factors as well. Okay, so when you're trying to pick out which commodity in this case might be affected most by inflation, you start to try and find double reasons, in which case crude oil seems to have more than one reason maybe to be bullish from a fundamental perspective. Now, obviously, that can change, right? That's why we use a stop loss. That's why we use risk management. A headline could come out that Russia agrees to end the war, and now there won't be any sanctions or tariffs put on their exports, and then you'd have the opposite effect. But that's why you do risk management. You have to trade with what you know now, and anticipate with risk management in case it changes. But with what we know now, barring any major changes, it seems like there's fundamental reason for crude oil to go up, and anticipation of inflationary moves might already be driving that type of movement. All right, so that's crude oil in a nutshell. We also could take a look, and this is interesting, if you look at what's been going on with platinum today, we could see a strong move up on platinum in the past 1, 2, 3, 4 days. And if we go to the 1 hour candles, we see just in the last 3 hours, platinum really bouncing off this support area that we drew in a prior session. It just moved around on the support and up it went just in the past few hours. And if we want to pair that next to gold, both are considered precious metals and maybe safe haven type metals to invest in if you have fears of inflation and fears of economic slowdown, etc., or fears of war for that matter. So if we take a look here and add gold side by side, it's interesting sometimes to do a comparison. What we see is very similar movement, but maybe not the exact same timing. Okay, so they've both been going, that is gold and platinum, to record highs, but not at the same time. And so now platinum took its turn to rush up to an all-time high just in the past few hours, and gold has pulled back over the last couple days. And so if it follows the pattern that we've seen, where one goes to a record high and pulls back, the other goes to a record high and pulls back, and then the next one goes to a record high, perhaps gold is set up here to follow platinum's move that just occurred in the past few hours. If there's a rush into a safe haven metal, precious metal like platinum, then perhaps there's reason to think gold will do the same thing. Now, there's no guarantee of that, obviously, but what we can do is anticipate potential moves and then act on them, and fundamentally it makes sense. So the technicals are there to show us there's still an uptrend on the precious metals, and that perhaps this is an opportunistic spot to get in for gold if you think the uptrend will continue, because over the last couple days, we've seen this pullback. We're looking at 1 hour candles here, and we've seen a bounce as well, with this still being in the larger pullback. So now maybe we go back, let's look at just the one chart, and we'll bring gold up. And so as we look at the gold chart, we can see if we can anticipate what might happen next year with gold. Now, the all-time high on gold was up here. Okay, this is the all-time high zone, and we just broke above this resistance level in the past week. We see resistance, and then up it went, a breakthrough candle, and then it came down and found support right at this resistance level a couple times, and then broke below. This was the move down, and now we've come back above this price level. Okay, this being a support level here. Okay, it was a key price level. Support, broke below and became resistance. So you see the importance of this price level from a technical perspective. Was resistance, became support where it bounced twice from this price, then a breakthrough candle and it becomes resistance once, twice. So this price repeating itself as a support / resistance price level, and then now we're broke back above it just in the past 2 or 3 hours. So with the rush up to an all-time high with platinum, we see gold breaking back above this support / resistance level and now sitting above it. So if I'm going to trade on this uptrend, and if I think it should follow platinum, then I don't need to get my stop loss very far down. I can put it below this support level, and if it breaks back below, then I'll accept that, hey, it's not the uptrend I thought it was. And since we know there are fears of US dollar weakening with rate cuts. We just had a rate cut. There's anticipation there might be more rate cuts, although they didn't commit fully to that with this last rate cut, but still it's there that rate cuts are expected. There might be reason for gold to be able to bounce up now with inflationary fears and tension that seems to be escalated now between Ukraine, Russia, and the NATO countries. So safe haven of gold, maybe having fundamental reason to rise. A technical move that broke back above this support level here just in the past couple hours. And so from a technical perspective, it's an uptrend as well. So if we want to take a look at a buy side here, we can then say take profit, all-time high would make sense that it could reach there if it's an uptrend without having to break the all-time high. We'd be at 37.90, could be a decent take profit. So if I'm looking at 37.90, stop loss down below this support level, I would just need to be below 37.50. So 37, let's say 45 or 47. So now I'm risking about a quarter. I can go a little lower with my stop loss just to make it a bit more secure. If it hits 37.45, then for sure it broke below this support level, and I'm risking less than half of the potential profit. Now I just need to come over here and say what trade size makes sense. So if I do one lot, I'm risking 1,300. If I do half a lot, whoops, that's 5 lots. Half a lot, I'm risking about 1% of my balance, a little more. So if I want to do 1% or 0.5%, you do the amount that makes sense to you. Could be larger even. 0.4, that's less than I was shooting for. 0.45, 0.46. Okay, so I'm at about 1% risk on the account, slightly above, going after over 2% potential profit, pushing 2.5%, and I can buy on that move. Okay, so a couple things that maybe are in your favor in a move like this. One, the fundamentals that we talked about. A couple different reasons maybe for gold to climb. And then two, the technical breakthrough that we have here, showing momentum breaking above this resistance/support level just in the past couple hours. And the third thing was the mirrored movements that we've seen between platinum and gold for the past months, where they keep trading all-time highs between the two of them, and platinum just broke to an all-time high. And so it feels like there's momentum on the sector of precious metals right now, confirmed through the platinum all-time high that it just hit in the past hour. So there are a few things here that maybe, even if you were a technical trader not looking at the fundamentals, you might buy on a move like this. Obviously, there could be a pullback, so we manage our risk to have a risk level that you're comfortable with, and then go after what could be a nice payout with over a couple % profit on the account. Okay, and you're not going to win on every move like this, but when you have the fundamental news in your favor and the technicals line up and make sense to you from an opportunistic entry point perspective, then it can make sense to make this type of move. Let me see, I think some other questions have come in. Nombali, good question. Yeah, many times you do see a relationship within a certain sector. And right now we're talking about precious metals, right? And so sometimes you're looking for a general trend within a sector, whether it's natural gas and crude oil. If you're looking at the energies and they seem to be racing up, but one has a better entry point than the other. In this case, we're looking at precious metals and feeling like gold maybe has a better entry point than platinum, for example. And we'll see if the momentum continues with the precious metals right now. So yeah, to answer your question, sometimes you do see crossover like that with different assets that are in the same sector, that they can clue you in. For example, sometimes you'll see, maybe the FTSE goes flying up to an all-time high, and the US 500 goes to an all-time high, and maybe you're looking at another country and thinking, okay, maybe it's a kind of a global marketplace anymore, and if the major indices are racing up, maybe you catch one that also is related with the same sorts of companies. Maybe it's the tech sector indices that are going up, and you pick one that hasn't made its move yet, that has some crossover correlation, and many times you can catch a better entry point that's anticipated before the next move is made on a particular index in this example. And sometimes it's better to stick. I'll see the NASDAQ make a move before the US 500, which is a bit more diversified, but carried heavily by NASDAQ companies that are within the US 500. And sometimes you can get some correlation there where you see NVIDIA and some major companies moving the NASDAQ up, and the NASDAQ makes its move quicker than the US 500, which, like I said, is a bit more diversified than the NASDAQ, but still heavily correlated. And you can get an inside peek, maybe an early peek as to what another index is about to do based on what another has done. And so, very good question. And yes, I do see some crossover like that for instruments that are in the same grouping, so to speak. Okay, let's take a look then at maybe another pathway. So up to this point, we've made a couple moves based on some macroeconomic and geopolitical things that are going on. Okay, we've talked about regional tensions with Russia and some geopolitical issues with Iran and crude oil supply, and we've talked about interest rates, which are large macroeconomic decisions, and the anticipation moving forward with those. But what about things that are happening right today? And so we can take a look at the economic calendar. And we can decide, do we think any of these announcements today will sway which way different currency pairings, for example, might move? And so today we have some different data points to look at, but out of the US, there's most definitely a focus. If we look at today's announcements, there's a focus on jobs numbers. And this was made evidently clear when Powell and the FOMC committee had their last meeting last week and lowered the interest rate in the US. The point that they made very strongly was inflation is not completely under control yet in the US from their opinion. And so why did they still lower the interest rate then? Because typically if inflation is higher than you want, you wouldn't lower interest rates yet. And their answer was because the risk of the poor jobs numbers has become worse than the risk of high inflation. So they feel that holding the interest rate higher would have caused more damage to jobs and has already caused damage to jobs, creating a higher risk than that of the risk of high inflation. And so they made it clear that it's not an easy decision. It was tough for them to lower interest rates and to decide to do it when inflation is still above their target. And they felt they had to do it because the jobs numbers have been really bad out of the US. And not to mention the more recent numbers being worse than expected, but also they had to adjust the numbers from this past March, 12 months back. They do an annual adjustment, and they had to lower the job creation numbers over that 12-month period by 900,000 jobs they had overestimated were created. So largely during the Biden administration, those 900,000 jobs that were adjusted downward, there was an overestimation of how many jobs were created. I think 10 of those 12 months were under Joe Biden, and a couple of those months into March were under Trump. So largely there was an over-reporting of job creation under the Biden administration, which was adjusted downward now, just a week or two ago. And so that created some doom and gloom as well, on top of the fact that the job creation numbers under Trump now have been lower than expected. And so with that understanding, we take a look at initial jobless claims coming in. If this number goes up as they're expecting, that's bad news, right? Jobless claims. We're not talking about jobs that are created. We're talking about claims for joblessness, for people who are losing work and applying for jobless claims, okay, for unemployment payments. And so it's already expected to tick up. So if this number comes in higher than expected, that would be deemed pretty bad news. And the fact that we already know there's a hyper focus now on jobs, and that's the whole reason interest rates were cut. If this comes in worse than expected, there's going to be fear that, wow, the jobs situation is really bad in the US. Now, that could have a silver lining, because then you'd anticipate stronger rate cuts. If that's the situation, there'd be anticipation of stronger rate cuts, which might cause an actual rise in the equities in the stock markets in the US in particular, but also it would give increased reason for people to run out of the US dollar and into a safe haven like gold and like platinum. Okay, so you can start to look at these numbers that are going to come out later today and understand, depending how these come in, gold could pull back, platinum could pull back if these numbers come in better than expected, right? If these numbers come in lower than expected, less jobless claims, that means better than expected, you could see the USD strengthen if these numbers come in that way, because the anticipation would be, we don't need to lower interest rates so fast because these numbers were better than expected. But the opposite, if they come in worse than expected, you could see the reaction that, wow, they're really going to need to keep cutting interest rates if these numbers are bad. And so short-term moves right now on gold, you could get stopped out as these numbers come in. And so you have to anticipate that ahead of time. But the longer move on crude oil, I think, would be maybe less affected with short-term bouncing until the next data set comes in, which, you know, each day, each week, we have more data coming out. This is just one instance of it, one snapshot, as this data will come in. Now, what we can look at more specifically is the effect on currency pairings with this tool. So as we look at the jobless claims coming in, if these come in, say, above forecast, we can look at and say, well, what has happened with the Euro-USD pairing, or any USD pairing for that matter? So Euro-USD, 1 hour after these events, if the actual came in above forecast, meaning worse than expected news, what we see is 100% of the time, the euro went up against the USD in the 1 hour that followed, with an average range movement of just over 30 pips. So that's exactly what we might expect, right? Worse than expected numbers on jobless claims, higher than expected, that would increase the anticipation of rate cuts. And so the USD weakens and the euro goes up 100% of the time in that hour. If we go 4 hours, it didn't hold. Okay, so timing is important as well. So 4 hours, no, it didn't hold. In the first hour, you had the reaction you would expect. USD weakening. But again, it's one data set. Longer term moves aren't going to be determined by one economic announcement, but in the hours that follow, you see the momentum in the direction you would expect, and then it fizzled out. What if this comes in below forecast? Okay, exactly what you might expect. Okay, 75% of the movement was down. A lot more downward movement, average range movement about 36 pips in the hour that followed. Okay, USD strengthened if the data came in better than expected. In this case, lower than expected, less jobless claims than expected. USD strengthens rapidly in the hour that follows. Why? Because now the anticipation is, if those numbers were better than expected, maybe they're less likely to lower interest rates next time. And so USD then strengthens in anticipation of less aggressive, maybe, rate cuts. All right? And also it makes sense that a currency would strengthen with good economic news anyways, even if we're not talking about rate cuts. So in this case, in the hour that follows these announcements in the past, it's going the direction you might expect. So how do you trade on this? Well, in the first 5 minutes after the announcement, perhaps they barely dropped. Look how small some of these moved, 2 pips, 3 pips. That's after 5 minutes. Most of these haven't moved even 5 pips. And it doesn't take 5 minutes to place a trade, right? You could have the trade set up, ready to go for buy and for sell. And when the numbers come in, if this came in below forecast, within 30 seconds, you could place your trade. Maybe you catch spikes up. And understanding that after an hour, most of the movement is expected to be downward potentially. Okay, and you can check out the longer time period in each direction. In this case, the downward movement held a little better after 4 hours than it did the opposite direction, but still it's less significant percentage-wise. There's reversal by 4 hours. In the first hour, you have the strongest percentage downward movement with this announcement. It's not the case for every announcement. Some announcements you'll see that after 4 hours, there's more significant movement percentage-wise and distance-wise. With this announcement, it seems to hold for about an hour, and then it starts to die out. So you get an idea of, depending how the announcement comes in, what direction statistically it shows you should maybe trade, and how long you should hold those trades, and the average distance that you might expect it to move before it runs out of steam. Okay, in this case, it was about 30 pips, 35 pips within that first hour. And so you have an exact trade plan that you can act more robotically based on the past data. And you would refer to this as data-driven trading. You don't have to guess. You don't have to go on a feeling. You look at the data from the past. You see maybe a strong statistical advantage depending on how those numbers come in as to which direction you trade. And you see if within those first seconds or minutes after the trade, you can get an entry point that you like, that's opportunistic for trading in the direction that you feel it will go in the next hour or 2 hours or 3 hours. Okay, and you'll find that certain announcements lend themselves to this style of trading better than others. If you look at the big announcements, CPI data, PPI data, GDP numbers, housing data, depending on which country you're looking at, you'll see some strong trends, okay, that look very, very predictable and that you might be able to find long-term success with this type of strategy. So this is a way to diversify your trading. We traded a couple trades based on larger macroeconomic news as we started the webinar, and now we're looking at more specific short-term moves that are really time-dependent, that you don't expect the news to carry over the next week. This type of announcement, you're looking in the hours that follow for that momentum potentially, for the predictability based on the statistics we looked at. Okay, and I would suggest over the weekend, you look at the big announcements that are coming, the ones that are marked high level, tend to have the biggest effect on the movements on the charts, and find the ones that fit your trading schedule that you could watch as the numbers come in. And even if you have just 2 or 3 each week that you could try, and then don't judge yourself on the first attempt. These announcements come out each week, each month. Within a few months, I could trade the initial jobless claims multiple times, and then I'll see which announcements am I having the best success with. Is it the CPI announcements, the PPI, the initial jobless claims, etc.? And then those are the ones you choose maybe long-term to trade on because you have the most success. Maybe you're winning 6, 7 times out of 10 with certain announcements, and you choose to go with those long-term. And others, maybe you have less success. And so that's how I would recommend doing this. We could look at the announcements for tomorrow, the next day, for next week. You can know what they are in advance. Okay, personal spending, that's probably a big one out of the US. If we look, it deals with demand on the economy, personal income level. A lot of these announcements create quite predictable movements. Okay, now where else can we look for fundamental news? We can take a look at the market buzz. And I know we're running out of time here, so I'm going to finish up just real quick on the market buzz. If you haven't used it, it's a very powerful tool because it allows you to find the most recent information without having to search all over the internet. It's done for you. This tool web crawls social media and news sites and finds the most recent information that it can. So the larger circles are trending the most online. So we might go to one of these larger circles and say, okay, why is Intel Corporation trending? It's actually had some issues lately, but all of a sudden, the prediction is over 20% rise expected. That's unusual, okay? We can look at the technical signal and we can see the technicals as to what's expected. Where's the resistance level? Where's it expected to rise to? This green area is where they're suggesting you might take profit. Okay, great, that's the technical side, looks great. And for technical traders, sometimes they'll trade just off of this information. It's there for you, even if you also want to look at the fundamentals. Now, I want to understand maybe what's the news. Why is there an expected 20% rise? And so maybe some of the recent articles will tell you that. And all of a sudden, just in the past 5 hours, you'll see Intel is in talks with Apple for investment as chip maker looks to bounce back. Well, that's big news to have maybe a deal going on with Apple. So you click on that, you can read a little summary of it, and you also can read the entire story. Just click the link. So you can find the source of exactly who posted this article and read the article for yourself and decide based on the most recent fundamental news, does this help convince me, maybe in this case, to buy on this technical signal? Okay, you can combine the technical signals with the most recent fundamental news and decide, do you trust that technical signal or not? And I've only looked at the first article that we see here. You might go down and read a few more, and that will help you decide what's the most recent news, not just in the last 5 hours, but maybe in the last 24 hours. And if you get enough news there fundamentally to make you feel, hey, the wind seems to be blowing up maybe for this stock, and then the technical signal tells you the same, then maybe you make that trade. In this case, since it's a US stock, you'd have to wait until the US market opens and see, did it gap up? Is it showing momentum? And if so, maybe that confirms upward momentum and you make your move. If it opens with a gap down, maybe you're apprehensive and you say, okay, something's wrong here if it's dropping. Unless you like the price and it gets to a nice support level, sometimes after a downward move, if you have enough fundamental news to support it, you still might buy in this case. Okay. Any questions, comments on the Market Buzz tool, how to utilize this area? There's really a lot of information you can find fast using this tool. Okay, I don't see any fresh questions popping up. There were a few questions that were there. I think I hit on most all of them. I see some questions about the economic calendar. The economic calendar, like I said, as we're looking at it, it's more of a short-term trading tool as each announcement comes in when you're using the data analysis that I showed you. But in general, it is additive. As you see economic numbers come in today, and then you look at the ones tomorrow, and if it starts to pile with positive data, now it starts to control the macroeconomic move as well, because it starts to become more meaningful, say, for interest rate decisions, if not just today's jobs information is positive or negative, but if then tomorrow's is also positive or negative and it starts to build, then it really starts to give you a feel for a longer term move as well. Good question. All right, everybody, we'll cut it here. Thank you for joining. I appreciate the questions and the participation. Good luck with any trading you do the rest of the week, and I'll be back at it after this week with more sessions. All right, everybody, bye for now.